Hi, I'm Alan Carter. I'm the president and CEO of Cabral Gold. Cabral has an advanced gold project in Brazil. We have a resource base of over 1.2 million ounces, and we've just released a pre-feasibility study on the a starter operation to mine the oxide resources on that deposit.
Alan, good to see you. I think you're in New York also telling this story. How's it going down there?
Yeah, good. I mean, obviously the current gold price environment, Matt, helps. There's a lot of optimism about the future of gold. So it's a good time to be putting out an economic study on a small little starter operation with low capex and very good returns.
Yeah, well let's get in. By the way, I agree with you. I'm over here in Los Angeles, pretty much doing the same thing. I think people are leaning into this gold cycle that we're seeing, so it's quite exciting. Let's talk about some of the numbers first of all, and then we'll kind of get into the what next and what you can do with it. So numbers, please.
Well, firstly, this is a starter operation. So as you know, Cuiú Cuiú is immediately next door to G Mining's Tocantinzinho mine, which was commissioned last month. That is going to grow to be the third largest gold mine in Brazil, knocking out about 200,000 ounces a year. And we have the project next door to that, which has a much bigger footprint. So because we have a very large project area with about 50 different targets, as I said, we've got about 1.2 million ounces in the resource base here. There's a lot of work to do moving forward. Thus far, like most junior companies, we have been relying on the tried and tested model of raising money by diluting the capital structure of the company. The problem with that is that in recent years, share prices have not reacted to results. And so you've got no control over your cost of capital. We want to get off that hamster wheel. We have an opportunity because we now have 320,000 ounces of oxide material. Most of the gold is in the hard rock below that, but there's a weathered cap, which is 60 meters thick. And this PFS is on stage one, which is producing gold from that weathered material. So in terms of the numbers, so this is a small little starter operation. It's not the main event, but the numbers on this small little starter operation are $37 million of capex. We're planning on mining about 2,000 tons a day. This is all free digging material, so it doesn't require any drilling or blasting. It's got pretty good grade. The grade in the initial year or two is about 1.4 grams a ton. It leaches extremely well. We've had Osenco do this study. So $37 million US of capex is, it's not hundreds of millions of dollars. It's well within our sort of wheelhouse in terms of being able to raise that capital. The initial all-in sustaining cost is about just over $1,000 an ounce in the initial years. It's a little bit higher over the life of mine. The IRR post-tax at gold price of $2,250 is 47.3%. Actually, at the current gold price of about 27, well, we modeled it at 27.10 as just to show what the variation would be in spot. It's over 80% post-tax IRR, Matt. I mean, this thing is going to make an awful lot of money. The NPV is relatively modest. It's only 25 million at 2250, but as I said, it's a starter operation. The NPV rises to about 50 million at current gold price. We're only mining in this PFS. We're only contemplating mining about 25% of the indicated and inferred ounces. So there's an awful lot of additional oxide ounces that will get added to this project as it develops. So we're very, very pleased with the numbers. I mean, as you know, most projects where you're seeing PAs, feasibility studies, etc., studies of this type, I actually looked at 30 of these over the last month or so, and the average IRR was 27%. So we're at 43 as a base case, and at today's gold price, we're at 82% rate of return. So, today's gold price, this thing will pay itself back in well less than a year. So tremendously exciting and a massive step forward for us.
Okay, I just want to be clear here what people would be buying into. If I'm an investor looking to invest in gold, there's lots of options for me. You talk about starter projects. So this isn't the main event, I think is your phrase. This solves for the problem of accessing capital in a cash-strapped environment like this to make sure that you're not constantly coming back and diluting shareholders. Is that the problem you're solving with this project?
Correct. I mean, we have a district scale project here. So we've got about 50 targets where we found gold either in drilling, trenching, or in boulders that are lying on surface. 50. So that's an awful lot of targets to investigate. It's obviously going to require some time and money. We've got a lot of upside to the existing gold deposits that we've found so far. We've got 3 new gold deposits that we don't have maiden resources in the hard rock yet. So there's a lot of work to be done. And our point is, well, if you've got a project this kind of size, which needs a significant amount of capital over a significant amount of time, then you need to have a stable cash flow that you control. And so this looks like it will be a broken ATM, to put it in one way of putting it would be that this thing will continue to generate cash for years to come. Now, the mine life on the PFS is only about 4.5 years, and that's because we've only considered in the PFS mining half of the indicated resources. You can't include the inferred resources, and so there's an awful lot of inferred material of very good grade in the oxide. So once we get in production, I think it will go way beyond 4.5 years. It'll probably still be going after 24 years.
Well, let's look at Alan. Let's look at that. There's a few things you said there, which are, again, I want to understand. I think people listening would want to understand. So, with regards to the ASIC you mentioned there, it's about $1,000, right? And at today's gold price, that you're up around, as you say, sort of 82-83% IRR, and NPV up at around $50 million. So that's kind of good. The reason that is the case is because of this free digging. I know you very quickly talk about free digging, but explain in a bit more detail what that does to your bottom line, the fact that it's free digging, and why.
Well, we've got about 60 meters of weathered material map, which is basically now clay. It's got gold in it, and that's resulted from the weathering of the hard rock material, the primary deposits over millions of years. So we don't need any drilling or blasting. This material that we're targeting with the PFS initially is not hard, to put no finer point on it. So it's low cost to mine. All we need are excavators and trucks to mine this stuff. Right. Similarly,
so less moving parts means less money, means higher margin.
Correct.
It's simple as that.
It's the same, really. The point I also made in my notes to shareholders on Monday was it's the same argument, really, when you get to the processing facility. So most gold mines around the world, as you know, the broken rock arrives from the mine at the plant, and then it has to go through a series of different crushers, and then it goes through a series of mills, big circular ball mills, SAG mills, rod mills, etc., etc. Now, buying those things, and initially CapEx is massive expense, and then operating them is massive expense because they require huge amounts of energy. We don't need any of that. Our material is mud, so we don't need a crusher or grinder. It just goes through a sizer, and then we add some cement to it to form pellets, and those pellets go on a heap. So it's not just the mining costs; it's the processing costs are very low, and obviously the CapEx is very low. We've purposely kept this project relatively small because we want to be able to finance it. There are a lot of companies, you know them better than I do, but a lot of junior companies in the space who have massive projects, but they're never going to be able to raise $300, $400, $500 million to get it into production. That's not our strategy. Stage one is to start mining these oxides, get some cash flow, use that cash flow to drill off all these numerous targets. Well, I mean, we're firmly of the belief here that we've got a multi-million ounce district. Grow that global resource at Cuiú Cuiú, and then stage two, of course, is then figuring out the economic viability of that much larger global resource. That would be a much larger step, of course. But let's get into production and get some cash flow as fast as we can.
I'm sorry to get you to explain this, but I think there's all levels of experience and knowledge, listening and watching and reading the stock. It's good to explain to everyone. So for those who are experienced, I apologize for the detail because you already knew it. But for those new, that's quite an important part because it affects margin, in this case positively. Let's get back to this life of mine, 4.5-year life of mine. You're looking at 50% of the measurement indicated. You're not allowed to, on a PFS, bring in the inferred number here. So that suggests to me that either this will, as you say, continue to be a 4.5-year life of mine for some considerable time. Again, how do you kind of play that, and how do you explain that?
Look, a priority for us now. So Matt, what we've said and what we said in the press release on Monday was that we have some more detailed engineering to do. By the way, this is a very good PFS. There's a lot of detailed engineering in the PFS that would normally be included in the feasibility study that we've done, and so we've got pretty accurate numbers in terms of CapEx, OpEx numbers. But in terms of what we do next, we're aiming to make a construction decision here in Q2 of next year. We've got a little bit more detailed engineering work to do. One of the key things over the next 6 months is obviously project financing, which I suspect you'll ask me about in a moment. But another key objective for us over the next 6 months is to really convert as much of that inferred material to indicated material. So the amount of available ounces that we will be including in the mine plan when we get to Q2 is only going up. So this PFS really is a sort of like a base case sort of scenario. The amount of ounces that we're planning on mining is definitely going to go up. And beyond that 320,000 ounces of indicated and inferred that we've got, there's an awful lot more material in the oxide that we're now starting to find. So, I think the mine life is going to be considerably longer than the 4.5 years. But as I said, you can't include inferred material in the PFS. You can include it in a PA. Obviously, we skipped the PA stage because we did an internal study that was so compelling. We jumped straight to the PFS.
Yep.
And I think that decision's been vindicated. 47% IRR is a sort of pretty much unheard of.
Case.
Yes.
Yeah, nice base case. Okay, so let's kind of get into the money here, because and remind you, the problem that this solves is access to capital, dilutive capital, right? That's what you'd have to do. What these companies like this have to do. No one wants that. You don't want it. Your shareholders don't want it. People looking in probably wouldn't want it either. So this is about generating cash enough to cover G&A, so you're not having to raise for that, cover exploration, so you're not having to cover for that, and any other kind of activity that you feel is important to look into the corporation, right? So let's talk about the amount of money potentially. You say in the release, it's average 2 years of operation is about just under 20,000 ounces. Doesn't sound like a lot, but this is a starter project. So we need to remember that number, one, either goes on for a long period of time or you decide to increase that slightly. So again, talk to me about the operational production.
Simple numbers, Matt. If we're producing 20,000 ounces in year one, which is about the plan, and the all-in sustaining cost to produce an ounce of gold in those initial years is $1,000, gold is trading above 2,700. So the margin here, your profit margin, is $1,700 an ounce times 20,000 ounces. That's $34 million US. Okay, $34 million US dollars profit coming straight out the gate. Now the capex is around about that. The current capex is about 37 million. So call it a year to pay off that capex. Beyond that, everything is just pure profit. You've paid off your capex. You're operating this thing. Maybe the OPEX costs go up a little bit, but you've got this massive margin. So you've got in the order of, moving forward, you've got in the order of $35 million US a year profit to feed back into exploration and growing your project. So, I mean, it's a massive opportunity for us. Look, there are very few companies that have the opportunity to start small like we have. Very few companies have 60-meter thick caps, or blankets as I call them, sitting above their gold, copper, silver deposit. So, it's pretty exciting.
It's pretty exciting.
Again, the PFS only contemplates mining about 80,000 ounces of the total oxide resource. The oxide resource right now, inferred and indicated, is 320,000 ounces. It's just worth remembering that. There is tremendous upside on the PFS. This study right now has fantastic numbers, and those numbers are only going to get better.
Well, I think the other thing to point out, and I think when people do their calculations, or most people don't bother doing the calculations, is the cost of capital as a result of these numbers, right? So, when you're going after the debt, your negotiating power is a little bit increased as a result of numbers like this. This isn't a high risk, technically it's not a high risk project, and it's also not a large project. So the cost of your capital will not be, that 1, 2, 3, 4% higher than it needs to be. And those sorts of things in the initial years can not kill projects, but make things very, very tight. We've seen a few projects in Australia suffer terminally as a result of those high costs from the debt providers. So worth considering in your thoughts, folks, if you're looking at this. Let's kind of talk about if you're okay. I kind of want to kind of set aside, what it is that the starter project is in terms of, what you're going to build, etc. And you've explained certainly the most important factors here. It's a case of what does it release? Because it's not about the starter project; it's about the big picture. What is your version of, what you're going to be able to do, and what does it mean that you don't have to do in terms of JVing or farming it?
Yeah, well, obviously, it puts us. We're not beholden to anybody. If we've generating $35 million of profit US a year, we're not beholden to the bankers, and we're not beholden to the share price. We're not going to be diluting the capital structure moving forward. So we can deploy that capital how we see best. Now, the reason we're doing this, of course, is because, as I said at the outset, we've got a district scale project. There's a lot of very compelling targets outside the known gold deposits that we have already. We know there's a lot of additional resources to be added in the existing deposits. But, Matt, as you know, earlier this year, we drilled 11 meters at 33 grams in a target that was sort of peripheral to everything else. And so, that just sort of speaks to the whole potential of this district scale play. Look, as you know, I was directly involved in the discovery of Tocantinzinho 20 years ago. So I'm well aware of the early exploration results that we had at Tocantinzinho. When I look at Tocantinzinho versus Cuiú Cuiú, for whatever reason, has a much, much bigger signature. It produced 10 times more gold during the gold rush from the streams, placer gold, than Tocantinzinho. The soil anomaly at Cuiú Cuiú is much, much larger, and we've got 50 plus targets. So, they have several peripheral targets, but we've got over 50. And so I'm very, very excited about the exploration upside and the opportunity to grow the global resource at Cuiú Cuiú. Now, we're currently at 1.2 million ounces. Tocantinzinho is about 2 million ounces. That resource is now 2 years out of date. We've done quite a lot of drilling to that. We think we're adding ounces all the time by drilling, but we're definitely getting up to a size that is getting very comparable to what they have. But I think the sheer size of the signature and the number of currencies we've got at Cuiú Cuiú, and the fact that we're drilling holes like 11 meters at 33 grams, really speaks to the potential of this project. I think it's going to be a very exciting time for shareholders. $35 million of cash flow profit a year will allow us to get very aggressive with the drill program, right? So you can imagine that would keep 5-6 rigs turning all year round, and we've certainly got the targets to keep those rigs going. So imagine how exciting this is going to be if we're drilling with 5 or 6 rigs all year round. It's going to be tremendously exciting.
Well, I think it can regionally, in the broadest context, not just Brazil, but you see what's going on in Guyana recently and nearby. We've seen, you mentioned, G mining ventures do that thing. We're also aware of some of the big players in the region looking to kind of consolidate and maybe get back to doing what they do best, which is throwing money at these things to expand them. How are you kind of reading that whole large district play and regional expansion for some of the big boys at the moment?
Well, look, I can't speak to other districts. I mean, our region, the Tapajós, as you know, was the site of the world's largest ever rush in history. I mean, New York, nobody here has ever heard of it. They've all heard of the California rush, of 170 years ago. The gold rush that happened in the Tapajós 40 years ago was 10 times larger than the California rush. And so, but I think that the fact that G mining has built Tocantinzinho on time and on budget, and all credit to their team, that shines a massive spotlight on the Tapajós. I certainly know that the larger companies that had previously had no interest in the Tapajós are now taking a very hard look at the Tapajós because they've just G mining's built a massive new mine in the area. So it's very positive for everybody with a project in the Tapajós. There's no doubt about it. 20 to 30 million ounces of placer gold, according to the mining agency of Brazil, was extracted from the streams in the Tapajós. That suggests to me there'll be a number of additional deposits. And look, on that, discovered, in the next few years. But Cuiú Cuiú was the largest one, Matt. In terms of historic placer gold production, Cuiú Cuiú was the biggest. So, as I said, it's a very unusual gold project, and it is district scale, and there's just so many fantastic results coming out from all these numerous targets. I mean, we've got lots and lots of things. There's a slide in the deck, very crowded slide in our corporate deck, which actually shows some of the results on these other yellow dots or targets in our district. I mean, some of the numbers are mind-boggling.
Well, look, I think it's pretty exciting where you're at, and maybe just going to finish things off here. Let's remind us of the time frame for each of the stepping stones between now and production. What does it look like?
Yeah. Okay. So the next 6 months or so, we will do the detailed engineering we require. We will do quite a lot of additional drilling aimed at upgrading the inferred material to indicated status so that we can revise the mine plan in about 6 months' time and include that in the actual mine plan. We're obviously going to be looking very hard at project financing options. There's a lot of interest in helping us get this project financed. So there should be an awful lot of news come out in the next 6 months. Now, in parallel with all that work, we're going to continue to do exploration drilling. Right, we've got this, as I said, this Mashishi Northeast target where we've got 11 meters at 33 grams. So we want to find out what that is. There'll be more results coming out from that area and other targets over the next few months, and that will all be leading towards hopefully a construction decision in Q2 of next year. Now, if the construction decision is positive, and certainly these PFS results are very, very positive, and of course the construction decision does depend on having the financing in place. It's obvious, but worth remembering, then it's a 12-month build, and which would put us into sort of initial production in mid-26.
There we go. It's as simple as that, Alan.
It's simple, but
I know. I jest. But like it's. I think what's been clear to me so following this story here. I said I don't have a horse in the race here. I'm just saying that when I look at exploration companies for the past 3, 4, 5 years, there have been moments when money's been available, but mostly not, and certainly not now. The money that's come in, so the money's been bandied around by large producers for M&A, has not cascaded down into developers and explorers yet. It'll be some time, so this makes sense to me. So I appreciate you explaining it to us, and stay in touch. We'll see you soon.
Thanks very much, Matt.